Director and a part of senior management of Indian Chamber of Commerce. Madam Preeti Chandrasekhar, India business leader, health and wealth, and fellow actuary, Mercer, and Mr. Sanil Nair, senior consultant, Mercer, Mr. Monu Fukon, general manager, PFRDA, and Madam Baharoz Kamdin, partner, Deloitte Haskins and Sons. And also, last but not the least, our MOU partner and Mr. CMA Chittaranjan Chattopadhyay, Chairman, BFSI and Indirect Taxation Committee of Institute of Cost and Management Accountants of India. Now, I would invite Madam Madhupala Bhomik to give the welcome address to all on behalf of Indian Chamber of Commerce.
Good afternoon, everybody. We welcome you all, the dignitaries and also the attendees for today's webinar on understanding the impact of pandemic on retirement benefits planning. It is my great pleasure and honor to welcome you all here today. On behalf of Indian Chamber of Commerce, I would like to extend a very warm welcome to everyone present here with us. Ladies and gentlemen, retirement is the culmination of the decades of hard work put in one's career. This should be the golden period of life, and one should be free from financial worries. Retirement planning is about ensuring financial independence for an individual after he concludes his active work life. However, retirement planning remains one of the low-rated priorities among the working population because most people feel that retirement is far away and nearer term priorities seem important. For many, there are financial obligations like home loan, EMIs, children's education, saving for children's marriage, and other things. And also accumulating a large sum of carefree retirement seems a daunting task for them. While the task is daunting, it is quite achievable if one has a good financial plan in place and starts saving for retirement early in one's careers. The pension industry in India is highly underpenetrated as nearly 88% of the labor force is without any formal pension provision, which indicates that the market has huge growth potential. In the recent years, the investment avenues available for retirement planning have enlarged. Employees Provident Fund, EPF, Public Provident Fund, PPF, retirement and superannuation plans offered by insurance companies and mutual funds are also some of the important avenues where people invest for their retirement years. With the introduction of the National Pension Scheme in 2004, there was a radical shift from a government-enabled pension program to employee-oriented pension program, wherein employees started contributing towards their own retirement funds while employed. Perhaps the one positive outcome of the uncertainty following the COVID pandemic could be that it has driven home the significance of financial planning and security, compelling many to rethink their priorities. People are beginning to understand the importance of long-term financial planning. This is evidenced by the importance given to both retirement and inheritance planning. Market fluctuations and job uncertainties are making people focus on long-term goals for self and family. Emergency savings have become the biggest reason for saving for people. While increasing the standard of living is still important to people, but now they are saving more in long-term savings as retirement and securing inheritance have gained higher importance. Thus, the pandemic has brought in the realization that retirement planning is not a mere saving or tax benefit choice, but also securing one's financial future. The ICC, even in these trying times, through its webinars has been actively involved in knowledge sharing regarding different sectors of economy as well as different aspects of business today. This webinar is organized as an attempt to educate about the benefits of pension planning and encourage adoption of pension products. So with these few words, I once again welcome all our eminent guests and speakers today who have come here to address us and our members. And we all look forward to very, very fruitful deliberations and interactions. Thank you. Over to Rajashi.
Thank you, ma'am. Now I would request our chairman, sir, Mr. Supratim Bandyopadhyay, to deliver his keynote address.
Thank you, and good afternoon, and welcome to this webinar that is being organized by ICC. And in fact, first of all, I must thank ICC and its officials, Mr. Ghosh, Madam Bhomik, and others who are associated with these kind of interactions with PFRDA for arranging a series of such webinars. And I believe this should be the fourth such webinar we have done in other places also. And during the pandemic with lockdown, physical meetings out of question, this is the only way out, I believe, to reach out to corporates in a big way and try to find out what they are thinking about retirement planning of their employees. So thanks ICC in the first place. I thank my co-panelists also, especially Preeti, Sanil Nair. They are going to give us a retirement benefit perspective and for India, and maybe they will give some examples from abroad also, and what is the situation like in India and where we are going to go from here. NPS has a lot of tax benefits also. So we have one taxation expert, Madam Behroz Kamdeen, will be talking about the taxation aspects. So that will also clarify the matter to our other participants. And we have with us our own General Manager, Mono Fukon, who will be talking about NPS in detail. There is a presentation on that. So that will give you the total view of the product NPS. As Madam has already pointed out, our pension system here in India is fragmented to a great extent. A lot of agencies and a lot of institutions, they are providing pension coverage in some way or the other. So much so that apart from our NPS, we have insurance related superannuation funds, those who are managing the superannuation funds on behalf of the employers. Then we have individually approved superannuation funds who got approval from the income tax authorities. They created a fund, but that is not coming under the regulatory ambit of either IRDAI or PFRDA or anybody else. We do not know their extent and the kind of corpus that they are managing, because we try to collect from CBDT. That process is still on, so we do not know the kind of corpus they are actually managing. Apart from that, yes, traditionally we take EPFO also, because EPFO has a part of pension in form of employees pension scheme, EPS, that also provides some kind of a pension. If we add all these things together along with the special provident fund schemes for different segment of people like coal miners, Assam tea planters, and all these things taken together, the total pension asset that we manage, all these agencies manage together, is just about 10% of our GDP. If you compare with some of the countries, we'll be surprised to note that some of the countries, their pension asset to GDP is even more than 100%, like Switzerland 148, and Australia 120, and UK is 105. So there is a lot of gap that is existing today in our pension saving system, and definitely all of us coming together, we have to create an awareness And again, my special thanks to ICC, because these kind of programs will go a long way in creating awareness amongst the employers, amongst the employees, and people in general, public in general, that yes, pension savings is necessary and it must start now. Because as we have seen, and as it was rightly pointed out, that is one of the last priorities of the people who are in the younger age group, those who have just joined the services. They feel that my retirement is away 30, 35 years. So why bother now? And as a result, what happens, mostly we see that late 40s or early 50s, suddenly they start thinking of creating a corpus, and by the time they understand that it is already too late. So much so, now in NPS also, we are getting group of people, mostly employees, those who have retired, and at the age of 60, they are coming and telling us, can I join now? Fortunately, looking into the aspects of senior citizens also joining, we kept the joining age open up to 65. But problem is, if you join at the age of 60, in any case, the NPS account cannot be extended beyond 70. So you get only 10 years to create a corpus. So if you really need a serious pension corpus to take care of your retirement needs, definitely it will fall inadequate. I was looking at a particular kind of a study yesterday only. There they say that whatever is the inflation, we know the inflation rates. Consumer price index a few months back only, it was above 7%. Fortunately, it has come down, though the core inflation is not coming down so easily. But still, it is hovering around 7%, little less than 7%. But what they say that if you look at normal inflation and if you look at the inflation in the cost of medical treatments is 3 times, the inflation there is 3 times of the normal inflation. And this is particularly one area which are the senior citizen, people who are going out of service at the age of 60, or those who have reached a pretty advanced age, they have to really think about. Other expenses we can still cut down, but medical costs are certain things really we cannot cut down. And as I said, the inflation rate there being much, much higher than the normal inflation, a large part of our savings go away in meeting the medical costs. So all said and done, so far as NPS is concerned, we started in 2004 only with central government employees, opened it up to state government employees. Almost all states, barring a couple of them, they have joined NPS. Then in 2009, we opened it up to retail participants, corporates. We have more than 8,100 odd corporates with us. But the total number of employees out of those corporates who joined us is a little over 10 lakh only. So that shows there is a long, long way to go. And maybe we have made a small dent, but we could not go further and we could not enlarge our base within the corporates. Already 45 large and medium-sized PSUs, they have joined us. They had their own superannuation funds, but they thought that the NPS system is a better way of managing their corpus in a safe, sound way with a excellent kind of a return that we are giving. And that's why they have shifted their corpus. Apart from that, we have gone into other corporates also, like big IT giants like TCS or Infosys. You know, today TCS is probably one of the biggest employers, or maybe the biggest employer after Indian Railways and Indian Postal Department. We don't know it. They are having a total employee base of close to 4.5 lakh. How many people are giving this kind of employment? But when we go back to TCS data and find that only 4.5 to 5,000 of them have joined us, then we really see the gap, where that gap is. And they are traditionally very young people. Their average age is very, very low, and large number of them are below 30. And still, this is the situation. So, as we said, that pension decisions are always postponed, and as a result of that, we cannot really make a large corpus, create a large corpus out of it to sustain our lifestyle and sustain our requirements after the retirement. So I believe these kind of sessions will go a long way, and obviously after all the presentations are done, there will be question answers, and we'll be very happy to answer those questions and try to find out that what kind of issues are really bothering the corporates or their employees. And if we can make the system little more user-friendly, we are always open to that. We have made many changes in the system. And during the pandemic, one particular focus was there that try to make it as user-friendly as possible, as paperless as possible. And to a great extent, we have been able to do that. Almost every month, we are bringing out new ways of onboarding. And not only that, we are making the exit at the age of 60 or even an early exit also very, very seamless. So at that point, a person does not feel the pinch that, yes, for exiting also, I have to take so much of travel. And we are trying to see that the person sitting at home can open their account, or they sitting at home, they can close their accounts also. We are trying to make it so easy for them that they will really feel that this is a scheme which is not only user-friendly, it gives a lot of information, and it's absolutely transparent, possibly the lowest cost in the world. We have checked up with IOPS, International Organization Supervisors, and you'll be surprised to know, it is little hilarious that our cost is so low, they don't take our cost for making their calculations. They say you are one of the outliers. And we are an outlier in the positive way, not in the way that we are above everybody's cost structure. They said very clearly, you are an outlier.
Request you to keep your microphones on mute if you're not speaking, because there's some background noise.
So I think NPS is, as we see, is doing well. We crossed the benchmark of 5 lakh crore sometime in October, and in 2 months, we added more than 40,000 crore of assets. So if it goes like that, despite volatilities in the market, I believe this year will be ending with somewhere close to 6 lakh crore. And the way we are growing is about 30 to 35% on assets under management every year, a compounded growth that we have seen. And steadily we are growing at this level, even though the base is going up. So with your support and this kind of sessions, I believe it will reach more and more number of people. And definitely NPS is going to be the pension product and the product of choice for people in this country. And we'll be very happy if we are able to help few more people, few more lakhs and crores of people to really come to us, join, and experience our kind of performance and experience the kind of benefits that we provide to them. So thank you very much for giving us this opportunity. And I hand it over to Mr. Ghosh for taking it forward.
Thank you, sir. Indeed, NPS is the product of choice for me at least, and some of my colleagues here. And now I would like to invite Madam Preeti Chandrasekhar, India Business Leader, Health and Wealth, and fellow actuary, Mercer, to deliver her thoughts. Madam, unmute yourself, please. Madam, unmute yourself.
You're able to hear me now?
Yeah.
Okay, at the outset, I would like to thank the Indian Chamber of Commerce, as well as, of course, PFRDA, with whom we have been doing a number of such sessions. And this is such a pet topic for us as an organization, and for me personally, that I always I'm very happy to actually share some of my thoughts relating to this subject. So, Sunil, would you be sharing the slides?
Yes, ma'am. You just share your PPT, ma'am.
Sunil, would you be sharing?
Preeti, I think Milind mentioned he will be sharing from.
Okay.
Milind, may I request, please?
Sir, can you pass the sharing right to us? Sir. Sir, can you pass the sharing right to us? To PFRDA?
I believe you have to pass the sharing right. Then we can share your slides.
Yeah, I have made a presenter, Mr. Salin Nair. Yeah, from your end, you can share your PPT or presentation.
Sir, I think the right has to be given to Mr. Milind.
Please give it to PFRDA, Mr. Milind.
Kindly check, sir.
Devobrata, give sharing rights to Mr. Monofukal.
But he is not at the visible. Has he joined? I told already.
Devo, please share the sharing rights to Chairman PFRDA.
Okay, I'm just giving. Yeah. Yeah. Given.
Thanks. The rights are duly passed on.
Thank you. Just a brief perspective from us, between Sunil and me, we will be covering three key aspects on, what is it that we're talking about. Clearly, we're talking about living longer. And so what is the next thing? Can we afford that kind of longevity? And third is what next? So what is it that companies can do to be able to help their employees plan for a better retirement, have better financial courage, etc. So if we move on to the next slide. Okay, so yeah, next please. Yes. So what are we seeing here? Clearly, pension systems across the world are all very different, but all of them are equally important. They are too important for us to ignore. Why? Because we are clearly going to live longer. What has happened is all studies that we're talking about indicate that we are talking about an aging population, and life expectation is going to be high. And actually in India, they say that life expectation at the age of 60 is going to be 80. So at 60, I would be expected on an average to at least live for another 20 years. So at the age of 20 or 30, I would really need to start planning for another 50 years, which seems a very daunting task, but not very difficult when you start early, very clearly. The next one aspect that we are seeing is that companies are moving away from defined benefit to defined contribution. So pretty much the responsibility of saving for retirement rests on the individual. And then you have, of course, aspects such as gig workers, etc., where you have people who are not sort of, olden days used to have our previous generation used to start a career at one place and almost retire at the same place. So nowadays, that's not how it is. So with frequent movement of people across different companies, it becomes very important for them to have a focused retirement plan independent of what the company is doing or not doing. And as Sunil will share with you, NPS is a very, very effective tool for you to take care of your retirement planning, while because it's portable and you can actually move it across when you move companies. And so clearly, you need to have a very robust and sustainable retirement income stream for yourself as retiree, so that you have better control and flexibility over your financial affairs as you move on. If you move on to the next slide. Yeah, so this is a particular index of ours, which we call the MCGPI index. And you will see that, the overall index, and the chairman, sir, rightly talked about our pension assets as a percentage of GDP. I mean, clearly, there is a lot wanting in that front. But this is a quick recap of where we stand in the larger scheme of things as compared to some other countries, where you talk of three key aspects of what does one get on retirement, how long will one get on retirement, and is there a risk of default when I get any kind of an income on retirement. While this is at the country level, I would urge that all of us start thinking about this for our own retirement planning as individuals. That do I have enough money? What will I get post retirement from my own savings? Whether I will be able to get it for long, that is, how long will I be able to get it? And is there any risk associated with the kind of investments I'm doing in terms of the returns, both on the growth of as well as the capital risk aspect? So this is what we wanted to talk of from a global perspective. If we move on to the next slide. The third and a very pertinent question is, can we afford longevity? We are looking at rapidly aging populations. And I talked about, the aspect that we all would be living longer, definitely. And this is another study which indicates that we have one of the fastest growing gap in our, between what we are looking at from the shortfall in pension savings through the retirement savings gap. So we are seeing that it is significantly high for both India and China. Many reasons. One is, again, as I said, rapidly aging population. Another one is a growing middle class. Clearly, the quality of life has improved, and the expectations on retirement also has changed for us as compared to the previous generations. So given this, it is important for us to just sit back and think, how much of income or replacement of income does one need? It's at the age of 20, 25 or 30, it's very difficult for me to ascertain as to how much money would I need post-retirement to have an effective and a proper life with dignity. So that's a question that we all grapple with, and in that sense, it's important for us to look at retirement planning in a very structured manner. So if we move on to the next slide. What happens during one's career? We are seeing that there's a lot of forces that work on us. I mean, you have the household expenses, you have the health and medical expenses, you have personal expenses, entertainment, you have your regular payments of EMIs, etc. You have your food expenses, transportation. All these are actually competing forces on your salary. And then, of course, you also have your saving. So you have multiple things, wanting their share of the pie, multiple expenses wanting their share of the pie, and yet you need to save. Why is it important? If you move on to the next slide, you will see that what has happened on retirement, this thing at the center, which was actually my salary, has gone. However, my other expenses continue. Some of them may get reduced. I may not have too many regular payments on EMIs, etc. I would perhaps be expected to go out less. Who knows? Or maybe I'll start to go out more. I may reduce to some extent transportation expenses because I'm perhaps not going for work. Or maybe I have slowed down and I'm actually working from home or whatever, taking it slow. But as the chairman sir talked about, the health and medical expenses are really, really going to increase. So what is going to happen then is that you will have, while your number of expenses go down, the the percentage of the income that each of the expenses by for actually increase. And so that really is a big challenge. And if you're talking about living till 80 or beyond that, you clearly want to make sure that your retirement income is adequate for you for the rest of your life. So that is about the what and so what. Let's see now what next. Let's move on to the next slide. Yeah. So this is another aspect, another illustration of what we talked about on whether corporate pension plans meet post retirement income replacement. We all think that gratuity superannuation or PF give us nice big fat sums because they look nice when you get them as a lump sum. But you know what? That with just the PF and gratuity benefit, one can only achieve an active income, achieve an income replacement of about just 20 to 25%, maybe 30% of the last round salary. And if you add NPS, corporate NPS, that too, it just increases to about 33 to 40%. So there clearly is a need for us to do much more. And perhaps not just look at the tax advantages of NPS as a tool for savings. It's not just about the tax savings. I think the focus really has to be retirement savings and not just tax savings. So we move on to the next slide. So this is another perspective on what we are actually seeing in organizations. So we talked about, what is it that we need to do next? So very clearly, employers have a big role to play. And I tell you why. We did a survey where we see that individuals prefer to work in organizations. At the top of the slide, you will see 4 out of 10 options talk about responsible rewards and protect employee well-being. And well-being, we all know, is not just about one's physical fitness, but all-rounded well-being is about physical, mental, social, and importantly, financial well-being. Then we also have looking at organizations on the left side, if you see, is talking about 78% of the HR expect wage stagnation to continue. If wage stagnation continues, what is it that employees want to focus on? Financial wellness education, financial wellness advice, long-term financial planning, enhanced retirement contributions, and flexible contract or reduced hours at retirement age. So if you see all these points, everything is circling around the fact that people are getting stressed because of for their retirement. They are getting stressed whether they will be able to earn that long. And COVID has really not helped us at all in terms of the confidence we have on ourselves, because it's very clearly has disrupted things totally, right from our savings to how the financial markets have behaved. So clearly, people are looking at different ways in which organizations can support. And if we move on to the next slide. So this is also another interesting one. Why is the role of employers so important in this DC world? And why is it important for employers to actually facilitate retirement planning and retirement savings? And why is it important for them to look at various ways in which they can do it? And NPS obviously is one of the most attractive ways for the employers to be able to facilitate retirement planning and financial courage for employees. You see here, why do employees join, stay, and leave an organization? You see 2 critical things that are featuring everywhere. One is pension retirement options and financial well-being initiatives. So clearly, this is on top of employees' minds. They might say, we want cash, we want a higher take home, but they will always really, really appreciate and have a higher engagement if employers do something to facilitate their retirement planning. If we move on to the next slide. Okay, what's happening over here? We are looking at retirement and we are seeing what is it companies typically would do towards retirement financial programs. What do they generally do? We generally run education programs through various modes. We will just take a bunch of people into a room and get a financial planner to talk about some products. that perhaps is really not enough, because what we have seen is just providing financial information is really not enough to change financial behavior. You need people to make wise decisions as financial consumers. And sometimes what we've seen is participants may find it very uninteresting or hard to understand if you just do a simple program. So very clearly, to Chairman's point, and we've heard it before also, where when we say that the number of corporate subscribers are increasing, but the number of people within organizations for signing up for NPS is really something that we can do a lot for. Very clearly, we need to engage them properly. Very clearly, we need to go beyond just a classroom training and look at various aspects, including the delivery of the entire solution or the NPS program, make it seamless so that the employees are also able to benefit out of it, while the employers would like to facilitate it. With this, I would hand it over to Sunil, who will talk about more on the ground details on what we have heard from our clients when we've helped them implement NPS. Over to you, Sunil.
Thank you, Preeti. Greetings to everyone. Coming on the slide, we would like to share some of our thoughts, what our clients and employees are talking about on retirement benefit and planning. So this slide gives an employer and employee perspective. So what is shown here is different generation of employees working together, but each with their own mindset of saving and retirement planning. For example, a younger lot, most of the times for them cash is king, and they would rather enjoy the present than saving for future. Hence, for them, the perceived value of retirement benefit is quite low. In fact, Mr. Chairman also mentioned same a while ago. Just opposite, for a middle-aged person, retirement saving or a sustainable standard of living post-retirement becomes one of the priority for him. Whereas from employer perspective, if you have to see, what they look for is minimum administrative burden and fiduciary responsibility when they look forward to implement or even evaluate any retirement program in the company. They would always like to play conservative without any risk on investment for their employees. We feel employers also believe that higher and better the employee engagement is, higher is the success of any such plans. They are also conscious of the fact that each age group have different priorities and their attitude differs accordingly. Hence, taking everyone together on this journey does become a challenge at times. If you see on the right-hand side of the slide, you see what employees' priorities are when they choose or pick any saving or retirement plans. They look for flexibility, simplicity, higher returns, and overall holistic approach to financial wellness, and not just sticking to one kind of a product or investment. Next slide, please. So what will work well? How can employers help? How can employer help, and what challenges they face? Today, from India pension perspective, organizations offer superannuation and NPS, as we have seen. Some offer either one of them or both. However, now more and more companies are moving towards NPS. Though we have seen NPS steadily becoming popular in corporate model, the take-up rate still remains a challenge. And we have discussed this even during Preeti's slide. Reason being, it's a voluntary pension program, as we all know. So engaging employees could be challenging. Topics related to financial wellness does not always excite all age groups, right? We have also seen just an education session on retirement planning for employees does not prove to be very effective always. So the question is, what makes a difference? Based on our own experience, we feel effective communication and personalized approach have a positive effect and result in higher engagement. We all agree today, NPS is a product with some really appealing features, and a lot of effort is going into make it more and more attractive as we move on. And all due credit goes to the PFRDA. However, it needs to be communicated well to employees for desired results. That's what we feel. Next slide, please. Let's talk a little bit more about challenges for both stakeholders. Here I'm referring to employer and employee. To start with employer, for most of the MNCs, global buy-in is imperative. because before they launch any such plan locally. We have seen global leadership would first like to be convinced before local teams takes over. The entire this process from global to local, this process really is time consuming, and to the extent that decision itself get deferred for a later stage. Third party payroll is another factor of challenge for employers. As you know, many companies today use a third party for payroll activities. Their system needs to be ready to include NPS as one of the component. Any delay at their end would also delay the entire launch for the company with regard to the NPS. Employee engagement and internal operational support are equally important tick in the box to decide for any such implementation. If you talk about employees' perspective from challenges for employees, I think we all know people at different levels of well-being and their responses to company initiatives are very different. Maybe I would still be attracted to iPhone today and retirement saving could take a backseat. The priorities are different. Another common issue, employees are unsure when to start saving, how much to save, what is the ideal time. They sometimes do have the intent to save, but when is undecided. And rather, the decision to invest get deferred every time. So is it fair to say lack of inadequate financial literacy is a big challenge today? I guess yes. We also feel right balance between employee expenses and savings, another issue employees face. And this imbalance would further result in no or inadequate retirement planning. Next slide, please. So here we come to the final slide and an important slide for that matter. What ensures success for NPS program in an organization? Take-up rate is a proof of the pudding. Effective and personalized employee communication does makes a difference to increase successful percentage. If employees relate themselves to the concept of retirement planning, they will opt in for the program. This is our own personal experience wherever we have helped organization implement NPS. Second point, if I have to refer, right partner for successful implementation is equally important. Here I'm referring to an efficient POP. An efficient POP would ensure smooth and timely account opening and grievance handling. A satisfied employee, we all know, will always speak high about the program to more and more employees. It spreads by the word of mouth. Thirdly, to ensure successful NPS program, a company should ensure regular engagement with their employees and not to treat the entire implementation as one-time assignment. This is an ongoing process because employees join, and so it has to this kind of engagement needs to happen at regular interval of time. So it's important to understand the intention action gap, as we spoke in earlier slide, where they have the intent, but when to take action, they're not very sure about it. A guidance is required. Can we also use an opt-out option instead of opt-in? Will that work? Maybe a good try. Finally, I think most important, a company leadership should always lead by example. They should be convinced for this program. They should be enrolled in the program and further convince employees on the relevance of retirement planning. This brings end to our session. Many thanks for your patience hearing. Thank you.
Thank you, sir. Questions have started coming, but we'll take them at the end. Now, I would request Mr. Monu Fukon to share his thoughts with us. Welcome, sir.
Yeah, thank you. I'll just keep it brief. Are you able to hear me, right?
Yes, sir. Yes, sir.
Yeah, just have a brief presentation slides on NPS, the features and its benefits. I'd like to keep it brief also. Just to start with, I'll just start with the features of the product itself as a scheme. So when we talk about NPS, it is we have enabled in a system as an individual pension account, which is identifiable to each subscriber in the system. So this pension account is a unique number which is portable across employment, and it remains constant even if the subscriber changes employment. So it is portable and it's transferable, across employments and geographies. That is the uniqueness of it. The number doesn't change till the person gives that. And we say that only one account can be, or a permanent retirement account number can be issued to each individual. There cannot be any duplication. So this is a unique pension number that we give to each individual under the system. Then, as said many times about this, the cost of running this scheme is the lowest in the world. And we always take pride in saying that this is the lowest pension product or scheme across the globe. There are flexible choices in this system, wherein we have fund managers choices, we have CRA choices, we have asset allocation choices, how the contributions will be invested in different asset classes, which I'll come back later in the slides. We have been able to deliver historically highest returns or the comparable returns to other competing market products or investment instruments that are available in the market, which is almost 10% over the last 12 years, which I also have a slide at the later part. Taxation part, a lot of benefits are there in contributions, accumulations, and on maturity of NPS, which Madam Behrouz will be detailing in after my presentation is over. Transparency and online access is there. In fact, when we say about transparency, is that the contributions are that are there, the charges that are there, how it's being reflected in the account, and how a person can, subscriber can access his account online or on his mobile app. That is also there, what we are talking about, transparency of charges, of the way it's getting invested, and the way a person can access his account. And over and above this, it's regulated by us. NPS, as we say, as I told you, but it's a unique number. We have classified, there are two types of accounts into this system itself. One, the Tier 1 account, which is the basic account, and the pension account, which has all the tax benefits. There are certain restrictions on withdrawal. And for opening the account, we require only an amount of 500. And per year contribution is 1,000 without any upper limit or any ceiling of any contributions towards this account. The other account that can be opened with a Tier 1 or a pension account is a Tier 2 account, which is optional. And there are no tax benefits except for certain central government employees. Has been recently been given in this current financial year. There are no restrictions on withdrawal. You can deposit today and take it tomorrow. Take out tomorrow. Then the minimum contribution is 250, and for opening this account, we only require 1,000 rupees. And there are no limits on the amount of contributions that can be made to this account. It's a freely withdrawable account, the Tier 2, and the Tier 1 is the pension account. To join the system, we have said that it should be a citizen of India and it should be aged between 18 to 65. So this is the only condition that we have kept. Apart from that, certain documentation are required for as per the KYC guidelines that are there. Address proof and identity proof are required. And this can be opened online through PAN and Aadhaar, or it can be deposited, or application form can be deposited to a point of presence, which are the distribution channels, mostly banks and NBFCs and brokers. We have 90 of those entities which are registered as distributors with us. Next comes, after joining the schemes, we have the accumulation phase starts. It starts with, like, you contribute after joining, opening the account with a minimum of 500. There are no maximum limit to contributions. So the contributions in the account can be made either by the subscriber alone, or it can be made jointly. So when we're talking jointly with the employer, the amount of contributions that flow, it can be equal, unequal also. And we have also allowed in the system that the employer can also contribute, either of them, employee or the employer. So there is a lot of flexibility in the system for making contributions in the system. So it can be a combination of the employer and the employee, or either the employee or either the employer also. So once this money comes into the system, it's deposited with our points of presence or being transferred to our bankers. So the money flows to the fund managers for investments according to the choice that they have exercised. So at the end of the day, the fund manager declares a net asset value of the schemes, and the contributions are then allocated units at the end of the day by the record keeper, which is being reflected in the pension account, that is the Tier 1 account, that will be reflected. So the money contributed will be reflected in the individual pension accounts as unit holdings, and the value of those units will be declared by the fund manager on a daily basis at the end of the day. So the final corpus grows, builds up over a period of time during the entire accumulation or the contribution phase. So after the contributions is over, we say that the normal exit happens at the age of 60 or at the superannuation age. So the superannuation age may vary according to the employer. If the age of superannuation is 55 years, we say that it's a normal exit. Or otherwise, if there is no employer relationship, we say that it is 60 years. So in an instance of a normal exit, what we say that the entire corpus, 60% of the entire corpus is being given as a lump sum. So that has been paid to the bank account, and 40% of those remaining balance has to be utilized for purchasing an annuity to receive a pension. So the annuity has to be brought from an insurance company. And in case of premature withdrawal, what is that? We say that after 10 years only a person can go out of the system. So in that case, we say 80% of that corpus has to be annuitized and 20% will only be paid as lump sum. But if the corpus is less than a lakh of rupees, so the entire amount is being handed over as a lump sum. In normal exit, we say that if the corpus is less than 2 lakhs, then the entire corpus is being handed over in the form of a lump sum. And in case of death, unfortunate death, the 100% of the corpus is paid to the nominee, or the nominee also has an option to purchase annuity also. So coming to choices, as I have told, in annuity service provider, we have 12 leading insurance companies which offers the annuity plans. There are varied annuity plans. There are, in a broad, there are 7 variants of this. And the most popular that has been there in the Indian industry is with return of capital. So the rates are also lowest, or the annuity rates are also one of the lowest in this kind of product. But in a pure annuity plan, wherein there is no return of corpus, the annuity rates are the highest. So at the point of exit, the subscriber has to choose any of the 12 fund, any of the annuity service providers, or any one of the 12, and he has to choose the annuity plan from which that annuity will be received, and 40% is the minimum, and it can go up to 100%. There is flexibility also in annuities in the corpus. So talking about more of choices, we have first the record keeper. We have 2 record keepers who maintains all the personal data and the accounting of the contributions that have been made by the subscriber. So it is NSDL and K FinTech. We have there is the only differentiating between this. The service standards are same. There is a slightly of cost differentiation to both the record keepers. We have 7 fund managers. All are leading fund experiences of fund management in the Indian scenario. And choices has to be made for selecting the fund manager by the subscriber who will manage the contributions. And this choice can be changed once in a year by the subscriber himself. The contributions also can be allocated to different asset classes. We offer 4 asset classes: equity, corporate bond, government securities, and alternate assets. And we have kept limits also onto this. So once the fund manager has been selected, the next option that has to be exercised is how the fund contributions will be bifurcated among these 4 asset classes. So equity, we allow maximum of 75% of the contributions will go towards equity instruments. 100% can be allocated towards corporate bonds and government securities, whereas only 5% allocation can be made to alternate assets. And this choice is also flexible for being changed twice in a year without any charges. The other allocation that we have, that was an active choice that I have told about. This is an auto choice, wherein the subscriber is not very confident of making an active choice or allocating the entire portfolio. What we have designed is that we have this contribution be divided into these 3 asset classes: equity, corporate bond, and government securities, in the proportion of their age and according to the risk appetite. So we have life cycle funds, which is life cycle 75, wherein it is the equity exposure is 75, life cycle 50, which is the equity exposure is 50, and life cycle 25, where the equity exposure is 25, or it's a conservative fund. So up to the age of 35, the equity exposure in all these 3 schemes, like it goes on reducing from their original allocation of 75, 50, and 25 over a period of time, such that it goes to a minimum of 25% at the end of 55 years, 10% in case of a moderate or the LC50 up to 10%, and in the last conservative, the equity exposure at 50 years, 55 years goes to only 5%. And simultaneously, the proportion to debt, like corporate bond and government securities, it goes on increasing. This also this choice also can be changed over twice in a year. From active to equity, auto to active also can be done twice in a year. So this choice is not sacrosanct that a subscriber exercises at the point of entry. This can be changed subsequently also going forward. Returns, as I've told you, that we have been able to deliver over the last 12 years more than 10%. The central government scheme and the state government scheme has completed more than 12 years, the central government scheme, wherein the equity exposure is less than 15%. So over the period of 12 years, we have been able to deliver, the fund managers were able to deliver 10.09 and state government schemes around 10%. Coming to equity, which has also, these are all the average returns of all the 7 fund managers. So equity over the period of 11 years has been able to deliver 11.34, corporate bonds around 10.33, and government securities around 10.17. Coming back to what is the size of the pension sector that we regulate and administer, this is a slide just to show and highlight the number of subscribers that have restored faith on the system. In NPS, and APY, we administer APY also. We close to have 4 crores of subscribers, of which 2.5 crores, 2.55 crores is from APY. Rest are all NPS subscribers. And the total assets under management is almost 5,44,000 crores. So what I was talking about today is about the non-government voluntary segment that we are talking about, which has around 75,000 crore of corpus, and the subscribers in both this non-government voluntary have more than 25 lakh subscribers have joined NPS. In the corporate segment, we have around 10,73,000 subscribers, and under the all citizen model, we have around 14,30,000 subscribers. As talked about accessibility and transparency, yes, we allow. We have mobile apps which are very convenient to use, which are available on both the Android and the iOS platforms. So a subscriber can view his contributions or his account statements or his balances instantaneously on his mobile itself. Both the record keepers have their own application software. Otherwise, also you can a subscriber can log in to his account through a web portal. That is also available, and transact online also, and into the account contributions. You can put redemptions into it. You can change your address. You can change your contact details also. Everything is possible, and accessibility is there for the subscribers to interact with the system online. Lastly, I'll just highlight the grievance system that we have. We have built up a robust grievance redressal system. We have a regulations for that. And we have set timelines for escalation metrics also if the grievance is not getting resolved or the subscriber is not getting satisfied with the resolution being provided at the lower level. So this is a matrix. The subscriber puts a request to the intermediary. The intermediary, if it's not resolved, it goes to the NPS trust, then to ombudsman, then to the authority. And even if it's not satisfied with the resolution provided by the authority, we can appeal to the Securities Appellate Tribunal. And all this has a timeline of around 30 days in the each escalation matrix. And we don't feel that any of the, and we don't have any experiences that any of this got appealed in the SAT. So thank you. This is what I had the presentation for all of you. Thank you, and over to Rajshri.
Thank you, sir. Very, very interesting questions are coming, Chairman, sir. And anyhow, I would now invite Madam Baros Kandin to share her thoughts on taxation and pension.
Chairman PFRDA, and Indian Chamber of Commerce giving us this opportunity to discuss tax implications. Can you put up the presentation? So NPS has advantages, and it's surprising that people have not realized the advantages of NPS. Basically, if you look at it, I was working in an organization which had pension, but since I quit before completing 10 years of my service, I was not entitled to that pension. So though I contributed the amount, the employer contributed amount to the pension account, I did not get the benefit of it. Further, I keep changing employment. We lose on the pension which is there as per their own pension schemes. So we don't become eligible. And NPS has a unique advantage that you actually the account stays with you. Even if you change employers, you can continue with your pension scheme. So I think that's the biggest advantage which NPS has, which earlier on we didn't have it in superannuation funds, which are private pension funds. The second advantage, and which Mono has given very good features on it, is return on investment. The return on investment on NPS has been quite good. If you've seen around 10%, and we have one more scheme within NPS which he highlighted, where you can have investment in government securities. So the most safest should be the government securities, because it's Government of India's own securities which are there, and that is giving a return of around 10%. A low cost NPS account giving a return of around 10%, and that too in government securities. So there's a lot of advantage from a return perspective. So when you look at both of these aspects, and the third aspect which is a defined benefit plan. So there are various schemes of pension. If you look at it, some have a defined benefit plan which says that on retirement you will get, say, 50% of your last drawn salary as pension for your life. Last drawn salary is quite high in the period when it was first given. But if I live for 20 years or 30 years post that, it is not material. So if I'm drawing a pension of 6,000 rupees 20 years back is good, but 6,000 today is of no use. So therefore, a defined benefit plan has its advantages and disadvantages. Similarly, what we have in NPS is defined contribution plan. So we are having a defined contribution that we do every year to get a corpus at the end of the retirement life. Out of that corpus, I have to buy of only 40%. 60% I can withdraw and invest in other securities. So only 40% of my corpus is getting locked into an annuity. I will get a return which is fixed. So it's only 40% and not the full amount. And therefore, balance 60% I can always put in other savings, other investments where I could get a return which for inflation. These are some of the very key advantages of NPS. And we really feel it's a very so now we come to the tax incentives of investment in NPS. Next slide. Thanks, Milind. So basically in the presentation, we're going to discuss on what are the benefits that we derive when we invest on NPS. What are changes with the Finance Act 2020? Changes in the Finance Act 2020. And we'll be discussing those and a few COVID reliefs that have been given by the PFRDA and on the NPS accounts. Now, when we look at the income tax benefit and when it's savings, we'll look at the entire life cycle of my savings. So we look at the tax incentives when the employer makes a contribution, when the employee makes the contribution, what is the actual annual accruals, the return on the investment that I get annually. Is there a tax benefit on that? And on maturity when I'm going to withdraw. So when we look at this sort of a life cycle, we look at all three. That's the case with all my investments. So all the investments, when we look at it, we look at the investment will give net of tax. If we look at investment return that we get, it will not actually be a true picture because I need to pay tax on that amount. There could be some cases where I'm paying a lower rate of tax, some where I'm paying a higher rate of tax. I could be in the highest slab brackets. So every individual actually should look at their investments which they're making for retirement or for their savings and look at the tax implications of that. And when we look at NPS, we are looking at these four phases in the life cycle of NPS to see what the benefits are, what the tax advantages are. Milind, next slide. So the first benefit that we see is deduction that an individual or an employee gets when he contributes to an NPS account. So there's a separate section 80CCD which provides for the taxation of contribution to NPS. As per section 80CCD1, when an individual contributes to an NPS account, he will get deduction up to 20% of his gross total income. So it's very important that we also look at this inner limits which are there over and above the outer limit which we'll discuss later. So when an individual contributes, he will get deduction only of up to 20% of his gross income. So though Mono mentioned that there is no, for the purpose of income tax deductions, there's a limit which is there. And employee, when the employee makes a contribution, he gets a deduction of 10% of his salary plus dearance allowance under 80CCD. And this entire amount of contribution, along with my other contributions to Provident Fund, life insurance, PPF, Public Provident Fund, they'll all be aggregated to come within a limit of 1,50,000. So my deduction limit of 1,50,000 also covers my contribution to NPS. However, in case of NPS, you've got exclusive additional deduction of 50,000 rupees. So if you're in the highest slab bracket and you've already exhausted your 1,50,000, if you contribute to an NPS account of 50,000 rupees, you get that full deduction and you save tax, around 30%, 35% tax is saved. So you immediately get a tax benefit by contributing to NPS account. So there's an exclusive deduction of 50,000 which is allowed only to a contribution to NPS. It is not allowed for contribution to Provident Fund, life insurance, Public Provident Fund, all the other deductions which are there under section 80C, they all get capped at 1,50,000. Now, earlier what government used to always believe in is that since we don't have a social security benefit which is given by government used to encourage savings. And they used to give all these deductions which are there under 80C, 80CCD, other deductions which are given so that you could encourage savings. In the current year, from the current year, they have introduced a new section 115 BAC, which is applicable from this current year ending March 21, which says that you may not claim any deductions and could go under lower rate of tax. So what the government is trying to say is that you could get a lower rate of tax without actually investing in saving products. So they're trying to bifurcate between savings and investments and tax. They're saying savings and investments should be looked at from perspective of return. Don't look at it only from perspective of taking a return advantage of it. So if you don't claim any deductions, you could come under lower rate of tax. However, when we really did the working for this was advantageous only for the people who are in the lower bracket. So individuals have a slab rate of taxation. Normal slab rates like 10, 20, 30% plus surcharge and cess. Individuals who are in the lower rate bracket rate, if they did not make any investments and they opted for lower rate of tax under 115 BAC were at advantage. But those individuals who are in the highest bracket, they still continue to get the benefit if they make investments and claim deduction. So this is something which every individual has to work out and see what is more advantageous. Is it good to make investments and claim deductions, or is it good to go under lower rate of tax? The second benefit which we look at is from an employer contribution. Employers contribute to the Provident Fund. Employers contribute to superannuation funds which they have, or employers' contribution to NPS accounts. Now, employers' contribution to NPS account is actually taxable as salary. The entire amount what the employer contributes to an NPS account is taxable as salary. However, the employee gets a deduction for the entire contribution made under 80CCD 2. So in one case, you have to show that as an income, but you get an entire amount as a deduction. So net effect is zero. So net, nothing is taxable. Amount, whatever is taxable has been added as income. And 80CCD 2, you get the entire amount as a deduction. Even if you opt for a lower rate of tax under 115 BAC, you still can continue to get the entire contribution made by the employer as a deduction. However, they have introduced a new section under perquisite 1727 by this Finance Act of 2020, and we'll discuss that a little later. Basis which there could be some amount of employer contribution and get taxed additionally. But we will discuss that a little later. So now as it stands, whatever employer contribution is done is salary taxable in section 17(1) itself. And you got to deduct D2. Now the annual accretion to the NPS account. NPS, they are giving good returns, 10% return is there. So annual accretion to the NPS account is not taxable. High accretion is not taxable because the amount stays in the NPS account itself. You cannot withdraw. It has to be there till your retirement. There's partial withdrawals allowed, but otherwise it cannot be withdrawn. However, the Finance Act has made some annual accretion taxation, which we'll discuss a little later. And that is very important to be looked at. Otherwise, annual accretion is not taxable. Withdrawal from the fund, partial withdrawal. So partial withdrawal, if you make from the fund, should not be. However, if there is, it provides for only in case of employees, if they do a partial withdrawal, it is not taxable. And that is only up to the extent of 25% of the total amount which is payable to an employee. So employees' contribution, 25% of that, if you withdraw, then that is exempt under section 1012B. The wordings used here is employee. So therefore, there's a doubt that if an individual were to withdraw from his individual account, will he get this benefit of exemption, or would it be fully taxable? As it stands today, based on the wordings of the section, it should be fully taxable. Now we come to withdrawal on maturity. On maturity, whatever withdrawals are done, it is fully taxable. It's clearly provided in section 80 CCD3 to say that the amount withdrawn is taxable except on death. However, what they have given is an exemption to say that if you buy an annuity policy, then that amount is not taxable. So the 40% of the retirement which is used to buy the annuity is not taxable. And 60%, there's a specific exemption given under section 1012A. So withdrawal is not taxable on maturity. 40% you buy annuity is not taxable. 60% is exempt under section 1012A. So the entire amount what you withdraw is exempt from tax. However, whatever annuities you received going forward after purchasing the annuity policy, the was of course taxable. That is, any annuities what you receive, even from a normal life insurance premium policies that you take, on annuity policies that you take, they are taxable fully. So in this NPS, it's actually an EEE account, exempt, because when you contribute, you get a tax benefit. The accruals are exempt, and withdraw, it is come in a sort of an EEE, exempt category. However, you need to look at the Finance Act 2020 changes which has been made. Now, contribution to Tier 2 account by central government employees. This is a specific deduction. Central government employees, when they make a contribution to Tier 2 account, Mono referred to this, but it comes within the 150,000. So if you're crossing the 150,000, you're not getting any additional benefit. If you're not crossing, then the central government employees get this benefit. Do not get this benefit, and individuals do not get this benefit. When we looked at one point which I missed is when I'm contribution of the employer to the fund, there also there's an inner limit which is there. Deduction which is allowed is basic salary. So if the employer were to contribute anything more than 10% of the basic salary, then that amount would not be allowed as a deduction. In case of central government employees, this limit has been increased to 14%. State government employees are still covered at 10% and there's no change made. So presently we understand that state governments could be contributing up to 14%. However, the deduction that has been allowed under 80 CCD2 is only 10%. So there's some amount that could be taxable in case of employers' contribution in case of state government employees. So we come to next slide, Milind. The Finance Act. So earlier, prior to the amendment by the Finance Act 2020, any contribution to an approved superannuation fund by the employer was taxable only if it exceeds 1,50,000 rupees. So we did have private superannuation funds where employers could contribute up to 1,50,000 rupees and it was not taxable. Employers' contribution to provident fund is not taxable if it doesn't exceed total income, total salary and DA. So you had employers' contribution PF, which was not taxable, employers' contribution to superannuation fund, which was not taxable if it did not exceed 1,50,000 rupees. and you had employer's contribution to NPS account, though taxable, but you get a full deduction for it if it does not exceed 10% of salary. So what the government has now done is that they have amended this clause of perquisites. They've deleted the contribution to superannuation fund exempt, the clause which was there, and they've introduced a new subsection 7 to say that aggregate amount of contribution made to the account of the SSC by the employer in a recognized provident fund, in an NPS account, or an approved superannuation fund, to the extent it does not exceed 7,50,000 rupees, will not be taxable. However, if it exceeds 7,50,000 rupees, it will become taxable as a perquisite. So you have a case where you are contributing to recognized provident fund, employer's contribution to recognized provident fund, NPS account and superannuation fund will now be aggregated to see whether it crosses the limit of 7,50,000 rupees. If it crosses the limit of 7,50,000 rupees, then that amount gets taxable in the current year itself. This change has been brought about by the Finance Act with effect from assessment year 2021, and 2021 assessment year means financial year April 20 to March 21. So this change has happened in the current. They have also consequently changed that any annual accretion of interest, dividend, or any other similar amount to the credit of the fund referred to in 7 above, that is to recognized provident fund, NPS, and superannuation fund, to the extent it exceeds 7,50,000, will be taxable. So annual accretion to the extent of 7,50,000 should not be taxable. Anything exceeding 7,50,000, on that excess amount, if there's an annual contribution, that amount also gets taxed. They are going to come out with the rules on how this is going to, the rules are yet not. These are annual accretions for the current financial year, 2021, because the income gets taxed in the current year itself. So we will have to wait and see what the rules are. How do they prioritize this? What will be taken towards the first 7,50,000? And what would come later, and then how the accretion is going to be taxed. So the rules are awaited, most probably in the budget released. They may come out with that, or they may prescribe separately. Next slide. Yeah, COVID reliefs. COVID reliefs are basically PF contributions, employer and employee, were reduced from 12 to 10%, but only for the first 3 months, May, June, and July. There's not been any extension after that. A non-refundable advance can be given to EPF members in the event of this pandemic. Question thus arises on whether the non-refundable advance, if it's given to EPF member, is it taxable or not. EPF recognized provident funds or employee provident funds basically are not taxable, but if supposing a person has joined and left without completing 5 years of service, then there's a taxation that comes in. So only in those cases you have to look at it. Further, we think our view is that since it's only an advance and the account is not being closed, it should not be taxable. But questions could arise, there's no clarification provided on the same. Partial withdrawal to fulfill, we mentioned that PFRDA has allowed partial withdrawal, and you need to look at the taxation from it from perspective what is provided in the Income Tax Act. Employees who withdraw till the extent of 25% of their contribution should not be taxed. Other than employees or anything withdrawn over and above the 25% could be taxable. Investments for claiming deductions for the financial year 1920 was extended up to 31st July 2020. This is as of, it's up to 31st July 2020. You can't make the, investments now and claim a deduction for the earlier year. But this was a very good benefit which government provided because of the pandemic and lockdown, that I could actually deposit something. Generally, I have to make investments before the year end, before 31st of March. Here, they've given us time limit to extend to deposit up to 31st July 2020, and I could claim a deduction in the earlier period. That is within the limits, of course. If it's anything exceeding that limits, you don't get the deduction. So if you've already reached 1,50,000 rupees or 50,000 rupees under 80CCD 1B, then you don't get any additional deduction in 1920. But if you have not reached those limits and you've made some investments by July 2020, you could still claim that deduction. Extension of timeline filing the return of income, it should be read as 31st of December 2020. So we have time to file the return till 31st December 2020 in case of individuals. On this, let us know. Thank you. Over to Mr. Ghosh.
lot of questions. I'm really happy at the and rich questions. I'm starting from back to front. I have suggestion to Chairman PFRDA regarding NPS scheme. NTPC has recently joined NPS corporate sector model, and we are experiencing that if all the communication, presentations, FAQs, and NPS are issued in bilingual, English and Hindi or local language, then it would help in better understanding of NPS by all section of employees, particularly non-executive categories of employees.
Yeah, of course, it is a suggestion more than a question. It is a suggestion. We take it. Yes, definitely. And we are trying to make it not only bilingual, but we want to make it in as many languages as possible, because the NTPC, like big corporates, they have offices across the country, and obviously there are people who are speaking different languages. So definitely we'll take note of it and do accordingly. Yes.
Sir, a formal vote of thanks will be given by CMA Chittaranjan Chattopadhyay after the question answers.
Okay.
Now, next question is, I have a question regarding transfer of superannuation funds of separated employees to NPS. Section 10(13)(5) of the Income Tax Act provides that payment from a superannuation fund by way of transfer to the account of the employee under a pension scheme referred to in Section 80 CCD and notified by the central government is exempt from tax. Question is whether transfer of corpus or separated employees, ex-employees are also exempt from tax. My taxation department and tax consultants is of the view that since the word used is NPS account to employee, transfer of funds for ex-employees is not exempt. This is again from NTPC.
I believe I leave it to the tax expert here, Madam Beros. She will be in a better position. Ma'am, you have any response? You have to unmute yourself. You are muted.
Look at the intent of introducing Section 13(5). It was very clearly provided that it is to help the transfer from superannuation fund to the NPS account. And therefore, if you look at it, whatever you get and whatever the individual gets from the superannuation fund also, he gets it as an employee. So if you look at the taxation of the pension amount, which an employee gets, even when he's retired or when he's separated, it is taken as salary. So he continues to be an employee of NTPC, and therefore he should be eligible for this benefit. And if you look at Income Tax Act also, if you look the way it is worded, the word former employer is there in various sections of Section 17, but there's no clause as former employee.
Yeah.
So I think if you look at overall on the broader perspective, I think the benefit should be given. But since the way the wordings are used, employee has been specifically mentioned, I think if they clarify this by CBDT, it would really help so that we don't have any litigation coming. Is that it should cover all members of the superannuation fund, because the entire fund is getting transferred. So if the entire fund is getting transferred, all members of the fund should benefit from it, and that should not be taxable because the entire money is going into the NPS account, post which it's going to become an account where the tax applications are provided. So when you transfer your corpus from superannuation fund to NPS account, 13(5) should be available. Intent seems to be very clear that it should be available. However, since the word is employee and there's a doubt raised, if the CBDT could clarify this, I think it would be very helpful. CBDT can make a clarification, maybe issue a circular, just give a clarification also. If they just give a clarification to NTPC or PFRDA, it would help.
We can take it up with the CBDT, but NTPC also can join. And what Madam is telling, I absolutely agree with that the intent is very clear. Today also, suppose a person retiring from NTPC receives sort of any pension or any annuity from NTPC, amount he or she receives is again taxable under the head salary, if you look at it. So though ex-employee word is not there, the intent is very, very clear. Otherwise, it would have gone under the head income from other sources. It does not go there. It is taken as income from salary.
Yeah.
So even for ex-employees also the tax treatment is same. So on the same grounds, it should be like that. But for a clarity, yes, we can always take it up with CVDT, and NTPC also can pitch in.
Next is a question from Anil Lobo. This is a submission to Chairman, sir. Under the corporate model, providing an auto-enrollment option or opt-out option could be a provision that can be introduced in order to increase the take-up rate. Is there any impediment in taking this approach? I also note that this was also suggested by Sanil Nair in his presentation.
See, auto-enrollment is there. Automatically, auto-enrollment is there. But since these are voluntary schemes, the problem starts there. And if we talk about the auto-enrollment as we see in other countries, especially UK, there the driving factor is not the auto-enrollment scheme. The driving factor is that there is a contribution to be made by the employer also. But most of these corporate schemes, apart from the few contributory schemes that we have, their employer is not the contributor. It is completely voluntary and it is only for the employees. So if employees join, yes, they can join at any point of time. So what we are trying, in fact, we have suggested a model to government also. Of course, they are the best judge. They will take a decision on that. Like people or organizations where we have less than 20 employees, we make it mandatory for the employer to enroll everybody in the system. But for a big organization like the IT companies I talked about, to make this thing mandatory will be difficult because they already have benefits like Provident Fund. It is already there. And already there is a pension coverage there. So obviously to make it mandatory for people, for organizations where it has more than 20 people will be a bit of a problem. So we are trying for very small organizations where the number of employees are less than 20 and where mandatorily EPFO enrollment is not necessary.
Another message from NTPC, they are happy that Chairman sir will take up with CVDT. They are ready to join Chairman sir.
Yeah, thank you.
Next question is from Jaswant Singh. Why is there any option of increasing age limit for contribution in Atal Pension Yojana?
Though APY was not the subject today, but since this thing is there, yes, it was there. In fact, yesterday also another proposal has gone. Government said that send a proposal up to 50 years. So we have sent a proposal, sent a contribution chart also for that proposal. So if that is allowed in the budget, then people in the age group of 41 to 50 also will be included. But that is subject to, again, government approval.
Okay, sir. The next question is not related to pensions. Basically, it's your opinion on interest rates. Will they keep on falling or will they rise a bit?
I believe we have one expert amongst us, Dr. Mohanty. Dr. Mohanty was Executive Director, RBI. So in his presence, we do not dare to talk about interest rates. So I invite Dr. Mohanty to join and give his opinion as to what should be the situation.
I wish I have the answer, but I think answer is not that simple, because I think this is one of the lowest interest rates that we are seeing in recent memory. But at the same time, that what we are seeing that inflation is going up. I'm talking the nominal interest rate, and is well beyond the tolerance limit of the RBI. That should not really happen because you have a negative output gap. Growth is quite low. Capacity is there. So inflation should not be sticky around that level. But given COVID and the situation here, that inflation remains high. So given that kind of a scenario, that you see that if inflation persists, so there will always be upward pressure on the interest rate. But at the same time, that we are seeing the mitigating factors because the liquidity position is quite good. So unusually high liquidity, and also helped by global factors because there are a lot of capital flows coming in. And it is also getting into the Reserve Bank's coffers. In that process, the liquidity is there in the system. Second, globally, that given the situation that interest rate globally at ultra low situation, and capital flow being good, because normally interest rate also used as a defense against if there's a capital outflow because the output comes down. So that situation is not obtained now. Given that, I think the Monetary Policy Committee is the best judge to take a view on the interest rate. But as you're seeing the last couple of pronouncements that though the monetary policy stance is accommodative, meaning that there should not be upward pressure on the interest rate, but interest rate downward movement is on hold. So given that situation, as long as these things obtain, because I would think that in the near future, perhaps it will remain stable. Because if you're looking at GSEC, 10-year, which is around 6%, but we don't know how the macro situation changes subsequently. Accordingly, the interest rate, would change. But as I said, it is anybody's guess, so we don't know. There are so many moving parts. Thank you.
Thank you, sir. Now I would like to invite CMA Chittaranjan Chattopadhyay, a fellow member of ICAI, associate member of Indian Institute of Banking and Finance, holding qualification from CIPFA London as Chartered Public Finance Accountant. He has 38 years of experience of working in commercial bank in different capacities. He has brought out several publications on banking for ICAI, which include 3 editions on risk-based internal audit of commercial banks, guidance note on concurrent audit of commercial banks, and internal audit of treasury functions of commercial banks. At present, he is Central Council member of ICAI and chairman of Banking, Financial Services and Insurance Committee and Indirect Taxation Committee of Institute of Cost Management Accountants of India. He is member of several committees of ICAI in separate. Well, welcome, Chittaranjan sir. Please share your thoughts with us.
Thank you, Mr. Rajoshi. It's really a really nice opportunity to listen to these luminaries. Respected Sri Supratim Bandyopadhyay, Chairman PFRDA, Sri Monofukan, General Manager PFRDA, Ms. Preeti Chandrasekhar, India Business Leader, Health and Wealth and Fellow Actuary Mercer, Ms. Baroj Makandin, Partner Deloitte Haskins and Sales LLP, Ms. Madhuparna Bhomik, Director Indian Chamber of Commerce, distinguished guests, ladies and gentlemen, and very special to Sri Mohanty. Just now I listened to him about the interest rate, what is going to happen. It's a very lucid way. It's a really very good evening to you all. It's a privilege to be able to deliver the closing remarks and vote of thanks at the end of this very engaging and enriching session. I extend my sincere thanks to Sri Supratim Bandyopadhyay, Chairman PFRDA, for being present here today, grace this occasion and enlightening us with these rich insights. I would also like to thank Sri Monofukan, General Manager PFRDA, for joining us for this important convention. I would also like to thank Ms. Preeti Chandrasekhar, India Business Leader, Health and Wealth and Fellow Actuary Mercer, for being with us today. I would like to thank Ms. Baroj Kamdin, Partner Deloitte Haskins and Sales LLP, for joining us today. I'd also like to thank Ms. Madhuparna Bhomik, Director Indian Chamber of Commerce. Last but not the least, I would like to thank our friends from the media for being present here and widely covering today's conference. I once again acknowledge the support of all concerned present here for making this initiative a grand success, of course. I think the interactions could successfully address the key issues about pensions. Here, I would just like to highlight a few salient points of the discussions in my vote of thanks. First of all, it's heartening to know total pension assets under management with pension sector regulator, Pension Fund Regulatory and Development Authority, increased by 35.76% and touched rupees 5.3 lakh crore in November 2020, as against rupees 3.92 lakh last year. A comprehensive social security net, such as pension, is critical to growth of the economy. It can serve two major objectives: providing income security to a vast multitude of our aging population, including in the informal, unorganized sector, and garnering long-term funds for critical growth-driving sectors of the economy and the capital market. Retirement planning should be one of our most important financial priorities during our working lives. A sound, efficient, and reliable pension system in the economy has gained urgency in view of the COVID-19 pandemic. The uncertainties emerging out of the COVID-19 pandemic saw increase in individual subscribers in the national pension system in financial year 2021 compared to the same period last year. I think, in fact, from the Institute of Cost Accountants of India, having a close tie-up with our Indian Chamber of Commerce, I would just like to state that presently the life expectancy of an average Indian is 69.73, which has increased by 0.33% in 2019-20. With advent of this particular development in medical field and having better access to technology, the life expectancy will increase manifold in the coming years. It's a peril that we have a certainty of the earnings till our earning age, but the uncertainty of living too long is reality, which we need to address through proper financial planning. We know that NPS is a wonderful product as it gives an individual resources when you see he or she needs the most. We feel that with the subscriber base is actually increasing over the years and the product having many advantages like exemption at the time of maturity, low fund management charges, choice of taking schemes based on risk appetite of an individual and lifetime earnings the product can provide. It is felt that still Indians are biased towards traditional investment like fixed deposits and post office savings, which has returns in negative territory of inflation, is deflated from the gross return, and the real return is abysmally low or negative. It is felt that professionals and people working in private and MNC still has not got the understanding of the NPS product. And the reason for its penetration at such low numbers, in order to encourage awareness, we from the Institute of Cost Accountants of India, in association with the Ministry of Corporate Affairs, and of course, we are also being very much fortunate enough that ICC with us, we are conducting the investor awareness program across the country through our network of 110 chapters for regional officers. The content of the program is to enhance the financial literacy along with financial planning for all states of society. The presentation also includes retirement planning as a part of the deliberations. We feel that CMS can effectively guide investors about the virtues of this NPS as a scheme, as it also has tax benefits for high-earning individuals and flexibility to contribute based on the financial prowess of an individual. It also has the USP of catering to all income strata, and we hope that in the coming budget, the long-pending demand of PFRDA of increasing the tax benefits of ATCCD be enhanced to rupees 1 lakh from the present 50,000. We also hope that government also should give exemptions for taxability of income from the annuity payments from NPS in order to encourage more participation from individuals. So in this pandemic has created opportunities and diversity for all sectors, and we from the BFSI committee have launched the certificate of investment management in collaboration with NISM. It has 3 levels in capital market, right from stock selection to mutual funds, derivatives, along with fundamentals and technical analysis of stocks. We also will be very eager to have a part of our investment management syllabus, the aspects so that the participants who clear the course has a considerable knowledge for this wonderful product, which is now a panacea for retirement planning. We look forward for a long association with ICC and to conduct this sort of beautiful program for the enriching, learning, unlearning, and relearning on this particular retirement plan. Thank you, sir.
Thank you so much.
Thank you, sir.